Hi guys, Mike here. Just going to record some of these investment videos for a couple of reasons. A few people have been asking me about stock tips, I guess, or stock ideas. People I know, so I thought I'd record some videos and just upload them on YouTube, just in case anybody else wanted to see them as well. Also, what I'm going to do is this is actually primarily what I'm doing is I'm going to invest or record them so that I can keep track of my own investment ideas and my thesis, and so I can check them later on what the actual outcome is versus what my thinking was, and then hopefully I can learn to be a better investor that way. Today's video I'm going to talk about Teva, which is one of my bigger positions. It's a very ugly company, an ugly investment. Most people dislike it. The stock's been beaten down. There's, over the last 5 years, everything's been wrong with the company. And being the kind of investor I am, I really like when things are just beaten to a pulp. I tend to be a very contrarian type investor. So if everybody thinks positively about something, I tend to think that the stock might be fully valued or maybe overvalued. And then if everybody is negative on something, then usually, not usually, some of the time you'll find real values, real company values that are mispriced just because of all the negative sentiment. So for me, Teva is one of those situations where I think that the sentiment is so negative that it's driven the company far beyond what its value actually is, to the downside. They've been in a bear market for years now, and everything, like I said, everything's gone wrong with the company. I'll go through the main things here, and then explain why I think that there's a turnaround possibly going to happen in the next 2 years, and that would be reflected in the stock price. So anyway, just a quick overview on Teva. They're a generics pharmaceutical company. They're listed on the Israeli exchange. It's an Israeli company. It's also listed in the US, TEVA. They do have some name brand drugs, but those aren't the primary drivers of their revenue or their income. Mostly they're a large generics company that focuses mostly on North America and Europe. In terms of financials, they have their earnings per share in 2021 should land around 250. I think if I'm remembering correctly, about 250 per share, and their free cash flow per share is over $2 billion. So that is, free cash flow is the amount of operating income, operating cash flow minus their capital expenditures and related items like that. So basically essentially the amount of cash that the company doesn't need that they can do something with. They have quite a lot of debt. They're about, I think it's about 24 billion in debt right now. And that's good. That's one of the main reasons why the company has collapsed since, I don't know, let's look at this chart, since about 2015. And I'll give you the market cap. The market cap is 9.25 billion, and the share price is $8.30 as I'm recording this. So if you do those multiples, the market cap is 9.2 billion, and I believe it's okay, just checking my notes here. The free cash flow is probably going to land at about 2.2 billion for 2021, and the revenue or the EPS is about 260. So if you do the multiples, the PE ratio is about 2 or 3.5 at these levels, or less than 3.5, and the free cash flow is just over 4 times. The market cap's 4 times free cash flow. So for any investment I've ever looked at, that's an extremely cheap multiple. I just looked at the Shiller PE ratio for this S&P, and it's almost 40. So if you take the PE ratio of 40, the Shiller PE ratio of 40, and versus the Teva P ratio of 3.1 or 2, you see that it's almost it's over 90% cheaper. So that's one of the ideas that I have here. But why don't we go through the issues they've had over the last 5 to 6 years. And so earlier on, they bought a generics company in. So let me organize my thoughts here. So we have three main issues. One is debt. One is earnings or the shrinking revenue, and the other one is legal problems. Okay, so the first one, the debt problem, they purchased a generics company in the U.S. Previous to this CEO, and took on a huge amount of debt. And their debt ended up being somewhere around 32 billion, I believe. Let me look. Sorry, 34 billion. And so 2017, they had 34 billion in debt, in net debt. And since then, what they've done is, so that's a big problem. The market hated this level of debt. It was way too high for the amount of cash flow that they had. So if you say 2 billion in cash flow, that's 17. The debt was 17 times the cash flow then. The EBITDA, I don't know, I forget what it was, but it was a very high multiple, higher than the market was comfortable with, higher than the lenders were comfortable with. And so what they've been doing is, for the last 4 years, basically just been paying down debt to fix this problem. So the debt, that's one of the big problems why the company got killed. Legal problems are another one. They have two major legal problems in the US. One is the opioid crisis. A bunch of big pharmaceutical companies and drug distributors are getting sued by almost all the states. And that's an unknown price tag. The other one is they have a price fixing lawsuit against them as well. That's not as big an issue, but it's still an issue that the market doesn't like. And the third one was revenue and profitability have been gross margins were shrinking. So I'm just looking at my notes here. What do they say? So revenue basically has been declining for a number of years now, and it looks like it's mostly stabilized now. COVID threw a bit of a monkey wrench in there with the supply chains and all that, but it looks like they're stabilizing now. So if we go through each of those problems one by one, I think that most of them. Oh, I guess first I should explain my thinking is on this company is that those problems will be rectified. And once they're rectified, the stock price will reflect that. The market hates uncertainty. It hates things going the wrong way. And a lot of the time stocks get momentum on the downside, and they develop this this perception in the market that they're just toxic. And so that's basically where Teva is. I believe all three of these issues will be resolved within 3 years. So I think the company should re-rate to at least 10 times earnings, which would put the stock at about a triple from where it's at now. And I believe that actually, even if one or two of those things is resolved, we'll get a fairly meaningful turnaround in the stock price. So let's go through them one by one. We have the debt problem, which was 34 billion in 2017. They're down to 21.7 billion, I believe, as of the last quarter. So that's a huge. They've gotten rid of over a third of their debt, and their target is to have a net debt to EBITDA ratio of under 3 times, and that's by the end of 2023. Now, the CEO the current CEO has been brought in to basically right the ship, and he's done a lot of things right since he's been there. He's implemented a huge cost-cutting program, which helped offset the revenue decline. Operating margins are increasing now, and he also believes that the legal problems will be resolved very soon. But the reason I bring him up is because everything he's talked about with the company has actually come to pass since he's been turning the company around, and he seems confident that the company is going to hit this debt target by the end of 2023. My belief is that if the debt gets to this level, what that does is it allows the company to stop paying down debt, use the cash for other things like dividends, buybacks, or possibly some growth plans. So when we get to that point, I believe the stock market will re-rate, even if the legal problems or the growth situation is the same as it is now, because that's the biggest cloud that's been hanging over this company is the huge amount of debt. So again, we have a catalyst. 2023, the end of 2023 is their target, and I believe that will have a meaningful impact on the company's valuation. If we look at growth, revenues have been declining, but in 2020 and 2021, that decline has slowed down significantly, and now the company is projecting growth of mid-single digits in the near future. So again, back to the CEO, Kare Schultz, I hope I'm saying it right, but he's saying that the company is going to hit growth at some point here. And again, if that's true, the market will re-rate the company. The market hates shrinking companies and they like growth. That's basically the way it works. So if we get a 5% growth rate, you can bet that the company's not going to be trading at 3 times earnings or 4 times earnings. It'll be far higher than that, assuming the profitability keeps up. But as we've seen, the profitability isn't really an issue for them. They've done well to maintain good profitability even with all these problems. So I'm not concerned about that. And also, they're in a very stable industry. Pharmaceuticals tend to be not non-cyclical, so which means that in a recession, they won't be hit like a lot of companies that are dependent on a strong economy. People aren't going to cut their generic meds. They're going to cut things like new car purchases. They're going to cut things like, renovations to their house or anything like that that's or maybe even holidays, flights, things like that. Those are the things that get cut first when people have financial problems. So again, revenue up is one huge catalyst, and I believe it's coming soon. The last one is the legal issues. These are harder to predict how they're going to land. In fact, I don't have a prediction how they're going to land, but the company's already acknowledged that they'll probably have to pay something out, and they've already taken the earnings hit on them on a lot of it by setting aside earnings to cover these legal expenses when the settlements or the verdicts come down. So likely what will happen is they'll either settle on their opioid cases, or they'll be found guilty in some of them, and then they'll end up having to pay a certain amount of money or provide a certain amount of drugs to these states for over a period of time. I've read things like, maybe 10 years. So if they said, for instance, if they had a $3 billion settlement, they would have to pay $300 million per year. That would have an impact, but I suggest you do more research on these. But from what I've read, it doesn't look like they're going to outright lose these cases. They've lost a case in New York recently, I think last week, but they also won a case in California a month or two ago. So that indicates that they do have a legitimate argument, and they might put pressure on some of these other states to settle because they realize they might lose the cases. So if these states feel pressure to settle, that's to Teva's advantage, I think, that they can come out with terms that they can swallow. But again, I don't have any real guess on how this works out. I guess what I'm doing is worst case scenario. Worst case scenario is they lose all the cases and they end up paying several $100 million per year for the next 10 years. And even if they do that and earnings got cut by, let's say, 25% because of it, you still have a very cheap company. So I think what the market doesn't like is that there's uncertainty here, and the CEO has said he thinks these are going to come to a resolution in the next year. I hope he's right on that, because once that resolution happens, either one way or the other, even if it's bad, it'll be in the rear view mirror. These one-off legal costs, I've seen them a lot in the market, and the damage to the stock price happens before the settlement, not afterwards, unless it's maybe a landmark case like those huge tobacco cases, which I actually don't even know how they worked out. But almost always the fear is where the stock gets hurt. So anyway, my thesis is that at least one of these things will materialize in the next 3 years, and I believe that all three of them have a good chance of materializing in that period, and the stock will re-rate to, let's say, 10 times earning. Could even be higher given the market environment now, where people are paying a lot more for earnings these days, especially if there's some growth to the company. But if it re-rated to a very reasonable 10 times earnings, you end up with a triple in 2 years. And I think the chance of that happening earlier is there as well, because the market tends to anticipate when things are going to happen. Once the market sees that the debt problem is going to be in the rear view mirror, you might see the stock re-rating, or once you kind of get a hint that the growth is there, the stock will react accordingly. But anyway, that's my thesis. I have another video on this one that talks about a way to get these shares cheaper than they're currently on sale for, and that's via cash secured puts, selling those. So for anybody who's interested, I'm going to do another video on that strategy that can help. Well, what it did is it helped me, instead of buying the shares for $8.50 a share, which we're sharing it and selling at the time, to get them for about $7.40, assuming those puts are exercised. But anyway, that's it for this video, and I'll put the link for the next video up as well if anybody's interested. Thanks. Have a great day.